Okay, we're going to talk about Chapter 11 right now. Chapter 11 is about bonds. Chapter 11 is the first of three chapters talking about through three primary ways people invest their money. Chapter 11's about bonds. Chapter 12 is stocks. And Chapter 13 is about mutual funds. Kind of as a beginning to this whole series of chapters about investments, Chapter 11 first discusses some general ideas about establishing investment goals. And these are really good ideas to think about. When you begin investing, it's really important to think hard about why you're investing and your goals for investing, and that should influence the type of investments you make. You want to ask questions about how much money you need to satisfy your investment goals. That the answer to that question might be partly determined by how much you can save. The more you can save, if you have an investment goal, let's say of $1 million, and you only can save $100 a week, that might require either riskier investments or longer-term investment. If you can save $1,000 a week, it's much easier to get to your goal of $1 million. You're going to have to think about how you obtain the money. In most cases, that'll probably be savings, although there are other options. For instance, you might potentially take a house, downsize it, and use the money from your house to invest. You need to think about your time horizon for savings and how much risk you're willing to assume. In the context of thinking about these questions, you have to at least consider what economic circumstances or personal changes in your personal life can alter your investment goals. So for instance, one thing that's probably relevant would be, what if you are unemployed, laid off from your job? Personal goal might be, what if you decide to have another child? So you maybe were thinking you were going to have one child and you end up having two children. That might change not only the ability to save, but also what your investment goals might be. And when you're thinking about these ideas about how much you can save in your time horizon, you're going to have to grapple with the idea whether your goals are reasonable. I would like to be a billionaire, but that's not a reasonable goal given the amount of money I can save. So you're going to need to think about the same thing for yourself. And as you think about investing, you're going to likely come to grips with the idea that you're going to have to sacrifice in some sense, and that is give up current consumption to allow you to purchase investment vehicles like bonds. This chapter, and in fact the entire rest of this book, chapter 10 through 14, all harken back to this important theme of the time value of money. And that's the idea that if you can save over a long enough period of time, the power of compounding will mean that even small amounts of money can grow to be a large amount of money. One thing as you begin to invest is you need to grapple with this risk-return trade-off. So here in this graph, on the x-axis, I'm measuring risk. So different things you will invest in will involve different amounts of risk. So things that are not very risky would be like insured savings accounts or treasury bills. CDs will be items, investments that lie to the left on the x-axis. On the y-axis will be what you can expect your return will be from an investment. So the risk-return profile is an upward sloping line. I've drawn it as a straight line. In other examples or other presentations of this, you can easily see it as an upward sloping, but a line with a curve to it. The idea is things that involve very little risk, like a CD or a savings account, will generate very little expected return, a small expected return, say only 0.5% or 1%. And in order to get a higher return, you need to take on more risk. You need to move to the right. So you might need to buy stocks or buy mutual funds that invest in stocks. So one thing that's important, however, you should remember as you make your investments is simply the idea that you're taking on more risk does not mean you're actually going to get a higher return. Okay, so on that graph, I've graphed 3 points, a blue point, a red point, and a black point, right? And so the blue point and the black point are on the frontier, or on the line. And so for the amount of risk associated with those investments, you're getting the highest possible reasonably expected return. Now, starting from the blue point, if you change your investments, so maybe you're going to add, you have a certain number of things you're invested in, some stocks, some mutual funds, and now you're going to add some new assets you're going to purchase, assets that are riskier. You'd like your assets to move up and be along or very near the line. For instance, you're going to engage in greater risk, but you might move up to the black dot, which has higher expected return. But it's quite possible you're going to take on more risk and not get any increase in expected return. And one prominent example of this that it's well known in the investing community, but actually apparently lost on the public more at large, is gold. So for instance, many people purchase gold in their portfolio. Gold has a lot of risk associated with it. It's a very volatile investment. The price of gold goes up and down. And yet the return of gold is not that high. So many investment managers, especially many academics, don't recommend you put gold in your portfolio because gold is an asset that the extra risk you take on by owning it, and risk would be the price volatility. Sometimes it's going up a lot. Sometimes it goes down a lot. That volatility, you're not compensated with a higher return. And so when your goal is to try to be along that risk return profile as much as you can. When you're making your investments, okay, broadly, whether you're buying bonds, stocks, or mutual funds, academics, people, specialists in finance, strongly recommend you engage in what's called asset allocation, or another term is diversification. You might call it, don't put all your eggs in one basket. The idea is you want to spread your assets among several different types of investments, and therefore your hope is if one goes down, you'll be compensated with other things that are going up. So for instance, a terrible idea was many individuals had put their entire retirement account in Enron stock. And when Enron turned out to be engaged in fraudulent accounting, and the company ultimately went bankrupt and the value of the stock was essentially driven to zero, those people, because they did not diversify their investments, essentially went from literally having $1 million in their account to $10,000 in their account. So they basically were wiped out. Had they engaged in proper asset allocation, they would not have lost nearly as much. Asset allocation and diversification are ideas that, number one, reduce your risk, right? By diversifying and not holding your entire portfolio just in Enron stock. That turned out to be an extremely risky investment. Nowadays, you might say the same thing about you're attracted to Apple or Amazon stock. You do not want to overly weight a portfolio to an individual company because that's very, very risky. You want to diversify. You want to diversify across stocks, bonds. You might want to have some risk-free assets like savings accounts or CDs. And you might also want to diversify into real estate. And even within each of those categories, stocks, bonds, real estate, you're likely going to want to diversify. And that is, if you're going to buy stocks, you're not going to want to buy just a single stock, right? Most modern portfolio theory recommends buying a lot of variety of stocks and bonds. And when we get a couple chapters down the road, the best way to do that is by buying mutual funds. But this chapter is all about bonds. What are bonds? Bonds, among the investment options of stocks, mutual funds, and bonds, bonds are probably the most conservative investment option, and therefore bonds in general are going to generate the lowest expected return, thinking along that risk-return profile. A government bond is a pledge to repay a specified sum of money, and that's the face value of the bond, at the time of maturity, and then along with periodic interest payments. Right, so you might buy a 30-year government bond for $10,000. Okay, and what will happen is each year or each quarter or every 6 months, you will receive an interest check, a check just for interest. And then at the end of 30 years, on your final date, you'll receive both an interest check and your original principal investment, your $10,000 investment back. Okay. The government bonds are basically issued to fund the national debt and just the cost of running the government at all levels. Very few governments truly run a balanced budget. There are 3 levels of governments that can issue bonds: federal, state, and then local, right? So we have the state of New Jersey issues bonds, the city of New York issues bonds. Now, in terms of terminology, actually, depending upon how long the maturity is, people use different names. If you're buying a government, you're basically loaning money to the government, but the term is 1 year or less. It's called a treasury bill. Okay, if you're buying a note, so you're loaning the money for somewhere longer than 1 year, up to 10 years, those are called treasury notes. And if you're going to loan for up to 30 years, that's called a bond. Okay, and then when you purchase treasury bills, notes, and bonds from the U.S. government, there's also a secondary market. All right, so if you, for instance, want to buy a treasury bond, but you only want a 20-year maturity, you cannot buy that from the federal government. The federal government will sell you a 30-year bond, but there's a bond market where someone who purchased a treasury bond 10 years ago, so a 30-year bond 10 years ago, now who wants to sell that? So you'll be able to buy a 20-year treasury bond from someone else on the market, just not from the U.S. government. The original issues only come in specific maturity dates. Relatively new financial innovation is something called Treasury Inflation Protected Securities. Okay, these are sold by the federal government in either 5, 10, or 30-year maturities. And what's unique about them, what differs from treasury bills, so again, let's consider our treasury bills, notes, or bonds, is that the principal changes with inflation. So again, let's imagine you bought a $10,000 and you bought a 30-year maturity bond. And what's going to happen, let's suppose that's a 5% interest rate on that. You'll receive 5% interest each year on that bond, and then you're going to receive the $10,000 way at the end. If along this 30-year period there is inflation, that $10,000 you're going to receive 30 years from now really won't be worth very much. Now, what happens with inflation-protected securities is as the inflation rate changes, there's an adjustment every year for the amount of principal you will ultimately be paid. Okay, so if the inflation rate goes up from 2% to, say, 7%, the amount of money that you will get in 30 years will be adjusted upward. And so it protects you, your principal, which you're not going to get for 30 years, it protects you from unexpected inflation. Now, when you buy government bonds as compared to corporate bonds, most government bonds are tax exempt. Some are tax exempt at the federal level, some are tax exempt at the state level, some are state and federal. There's all sorts of combinations. But what's important is when you buy a government bond is that you need to adjust the interest rate or the yield that is on the bond by your tax rate to calculate the equivalent interest rate you have to receive from a corporate bond to be the same interest rate. So for instance, suppose the government bond had a 5% interest. Okay, so in the bottom equation, I wrote 0.05, so that's 5%. And suppose you're at the 28% tax rate. Okay, your marginal tax bracket is 28%. The formula is in the numerator is the tax exempt yield. So this is what the government bond will give you, 5%. And then the denominator is 1 minus your tax rate. So if your marginal tax rate is 28%, it's 1 minus 0.28. Okay, and so if you plug it into a calculator, you get 0.0694, which is equal to 6.94%. Okay, so what does this mean? A tax-exempt bond that you purchase is equivalent to getting a corporate bond that is, the interest is taxable, of 6.94%. So if you're trying to decide whether to buy a corporate bond and a government bond, if the corporate bond is not offering at least 6.94%, you don't want to buy the corporate bond, you're going to want to buy the government bond. On top of that, the corporate bond is going to involve some greater risk. There is a possibility that the corporation you're loaning money to may have a problem paying the maturity when it's due. That's not the case, at least most of us believe it's not the case for the federal government. So I would argue you need more than 6.94% because you need to be compensated for either the modest amount of risk of default by the corporate entity or perhaps in some corporations a large amount of risk. Okay, but if nothing else, you need to know how to calculate the taxable equivalent yield. Okay, so I've been kind of talking about corporate bonds. Corporate bonds are when you're loaning money to corporations. They work similarly, broadly stated as to a government bond, and that is it's an interest-only loan during the time that you're loaning the money until maturity. You only receive interest payments. Okay, and then at the end of the period of time, so if you've bought a 10-year corporate bond, you'll get the principal that you loaned the corporation back. Bonds are generally considered safer than stocks. If a company goes bankrupt, in general, bondholders get priority to get paid before any kind of liquidation goes to stockholders. Some people talk about it as a fixed income security because you're kind of a specified interest rate you're going to receive. And the maturity date, the term maturity date, refers to the date and when the face value is repaid. So if I were to buy a 20-year corporate bond, the maturity date would be 20 years from the date I purchased it. Now, one important thing you need to know about buying corporate bonds is most corporate bonds have a feature that's called callable. And that is, imagine a corporation needs to borrow money, so they issue bonds and a bunch of individuals buy the bonds. But then perhaps the corporation does much better and it can pay back its bonds quicker. Or suppose interest rates have fallen a lot since it initially issued the bonds. And the interest rate used to be 7%, and now the interest rate's 3%. Corporation doesn't want to pay 7% bonds. It'd really like to have 3% bonds. Most corporate bonds are callable, and that is the corporation, even though you really think you've got a 20 or 25 or 30-year corporate bond, the corporation can say, you have to sell it back to me now. I'm giving you your money back. Quite often, callable is not allowed for the first 5 years after a bond issue, but you could easily own a corporate bond that you're getting an excellent interest rate, and you're going to get a letter in the mail that says, we're calling in this bond, here's the check, we no longer going to pay you interest payments for the next 20 years. And so this is a feature of corporate bonds that creates risk for investors, because you might think you're going to get a certain stream of interest payments, and in fact find out that that nice stream of interest payments is cut short because of the callable feature. Finally, I want to say that corporate bonds, quite often what you have to do is calculate the yield on a corporate bond. The price of a corporate bond varies over time. So again, these corporate bonds, just like government bonds, they're sold on another market. They're issued by the company, say IBM or Apple or Microsoft. But after the initial sale, there's a secondary market where people can buy and sell these government bonds or these corporate bonds. And so the initial corporate bond offering specified the interest amount, say for the $10,000 corporate bond. So it might say that you're going to get $450 each year in interest. And if the current price is $10,000, then that is equivalent to 4.5%. But if the price changes, goes up, let's say, then that $450 is being divided by a bigger price and the yield goes down. So this is really important to know that the yield moves in the opposite direction as the price of the bond. When the price of the bond goes up, the yield goes down. Or conversely, when the price of the bond goes down, the yield goes up. So interest rates on bonds move the opposite direction as the price.